And to begin with, we're really very privileged to have David Kostin here with us. David is Chief Equity Strategist for Goldman Sachs. He's responsible for views on the U.S. stock market and to communicating these views to the firm's institutional investor base. Prior to assuming his current role in 2004, he spent 17 years as a research analyst on Wall Street, focusing on the real estate industry. David joined Goldman Sachs in 1984 in equity research and was named managing director in 1998 and a partner in 2010. Prior to joining the firm, David worked at Salomon Brothers from 1986 to 1994 and previously served as president of the Real Estate Analysis Group of New York. David earned a Bachelor of Science in Applied Mathematics, magna cum laude, from Brown University. Please join me in welcoming David Kostin. Thank you. This will be a conversation with David Shulman, and so David Shulman, let me turn this over to you.
Okay, well, first, the other thing that Jerry didn't mention is that I had the high privilege of hiring David right out of Brown at Salomon Brothers in 1986, and he was a very precocious 11-year-old at the time. And he then went on to much bigger and better things at Goldman Sachs, and as Jerry said, he now has the partner status, which is at Goldman, which is a pretty big deal. So, David, let's just start off. Why don't you just briefly outline what you're telling your institutional clients, what your view is on the stock market, and the other thing you noted is, even though you didn't use those words, you didn't say cash isn't trash anymore. You didn't use those words. You were more eloquent. And so can you comment on that as well?
Sure. So I appreciate having the opportunity to come and speak with you, and I think it'd be appropriate for me to acknowledge Brett Sanchez, who worked at Goldman Sachs for several years and is a student here at UCLA. So I'm happy to see him in the audience. He did really well. And if you have any employers out there, you should focus on him on a substantive basis in answer to David's question. So the baseline forecast for the economics outlook at Goldman, and my responsibility is for the U.S. stock market, and I'll get to that in just a second, but the economic forecast is a deceleration in growth over the next several years. So there is no forecast recession in the outlook for 2019, 20, or 21. Now, I know this is the forecast project, and I'll say that my experience in 30 years is no economist has ever forecast a recession, because it would be considered professional suicide to do so in forecasting something that doesn't ultimately materialize. And so the idea of deceleration of 2.5% GDP growth approximately, annual average for this year, or looking into 2019, decelerating down to around 1.5% approximately in 2020 and 21. So that's a gradual glide path towards sub-trend economic growth, trend being something in the vicinity of 1.75%. So that's the backdrop to the economic environment that then drives or helps inform the outlook for the stock market. Now, the way to keep that in mind is think about real GDP, of roughly 2.5% for next year. Assume inflation around 2%. So your nominal GDP is going to grow around 4.5%. Most companies grow their revenues around nominal GDP rate, so about 4.5%. We're assuming and modeling and forecasting flat margins. So your revenue growth of 4.5% becomes earnings growth of around 4.5%. And there's about 200 basis points, about 2 percentage points of accretion from corporate repurchases and corporate buybacks. And that drives earnings growth of around 6 to 7% in aggregate for the overall market. And that's skewed into areas in certain sectors, but in aggregate, that's the kind of profit forecast we're looking at. And so with that as a baseline economic outlook and a profit outlook, the question is what valuation is likely to be assigned to those earnings. And I think this is the critical issue, and we can talk about this, I'm sure we will in this discussion, is the probability of a recession in 2020. Because the title of this session, I know David described it as the view from the other side of the Hudson. So most portfolio managers sovereign wealth funds, pension funds, endowments, most long-only institutional mutual fund managers, a lot of the hedge fund community, is anticipating a contraction in 2020. And so the reductive way of thinking about the stock market, I gave you a sense of earnings. Market trades at 16 times forward earnings today, approximately. Depends on the day. Some days higher, some days lower, right? But about 16 times. If you were to head into a recession, the market multiple would be at 14 times. And if the expansion was deemed to be longer lasting, then the market could trade at 18 times. And so 14, 16, 18 times is the kind of range that you would think about. But the baseline forecast that I have is the U.S. stock market and S&P 500 will end 2019, next year, at 3,000. And so yesterday, or 2 days ago, the market closed around 2,800. Last night it closed around 2,700. So you can kind of depend on where we start on the, and since it's a day of tribute to President H.W. Bush, think about that. He was landing his airplane on an aircraft carrier, and the aircraft carrier is sort of moving in the seas. We're trying to land a single point estimate at the end of 2019, but 3,000 would be a level of the market in our forecast.
So it'd be like 9% gain from last night.
Right.
So
It would be
9 to 10%.
it would be less from the day before.
Yeah, right, less from
Right.
the day before. So given that view do you have any particular sectors or types of companies that you like or dislike in this kind of a market?
So the thought process in where to orient oneself inside of the stock market is informed by the view that the economy is decelerating. And so with the risk to the downside, there is obviously potential to the upside, but I think the bias is slightly lower. We're looking for durability of cash flows, visibility, stability, and so the recurring sense of cash flows one can find in certain areas of the market, and certainly some areas of legacy technology. I reference legacy technology because the tech sector split at the end of September, and some of the sort of social media darlings moved into the communications area. So if you look at legacy tech, some of the software and services companies, when you look at that revenue stream, it's highly recurring. So as an example of Microsoft, used to be 40% of its revenues was recurring, sort of subscription-based model. Now it's around 60%, heading towards 70% over the next several years. You look at Salesforce as a classic example, something that's almost entirely a recurring revenue model. And that model and that visibility is worth something in an economy that is decelerating. So that would be one area, a big focus for us. The idea of prescriptions, you think about healthcare and prescriptions, I think of the subscription-based model as a variant of a subscription. You're on a certain kind of medication, you're a certain amount of software you're using, and that's a recurring basis. So that's one area. Utilities, which is another relatively defensive, has a very low beta, since the concern is the downside. Well, they're trying to mitigate downside risk. So those are some areas that we would focus on inside of the market right now.
What don't you like?
So what we don't like would be some areas where there's less opportunity in terms of, we'll look at consumer staples. Argument here, while it's also historically been a defensive sector, I'd argue that many of the products are on the losing end of history. And there's been a shift in some of the consumer preferences. There's less brand affinity, less brand loyalty in the world of internet. The internet has, I would argue, in many ways devalued or lowered the product-specific allegiance of many consumers. And that is a headwind for many consumer staples companies as compared with so the delivery mechanism, which is brand agnostic. And say in the delivery side, you could look at Amazon as an example.
Okay. What kind of pushback, when you talk to your institutional clients, when you give them your view, what kind of pushback do you get from them? Because I know when I was an analyst, I would say something, and the client would immediately say, "You're out of your mind. A, B, and C. This is all you're all wrong." So, what kind of pushback do you get from your clients? What are they telling you? Because they're the ones ultimately that are going to make the prices. Correct.
So so I said at the very beginning, the Goldman baseline forecast is that we'll not be in a recession, that the economy will continue to grow, decelerate, but continue to have some growth. And in that environment, as I just said before, you have a real GDP growth, you have some inflation, that is likely to drive sales and drive earnings, and higher earnings is usually associated with a higher stock market. So that's the baseline forecast that I have. The pushback comes and concerns about the fragility of the economy and that we're above potential growth, and therefore you're getting inflation and the Fed has to hike. So basically a lot of the debate relates to the sort of path of tightening the Federal Reserve, whether it's going to increase rates. Goldman Sachs' view is a number of times, because there's still inflation bubbling up in the system, but a concern about whether there'll be too much tightening and tip the economy sort of into recession. That's sort of one area of risk. There's concerns about corporate margins, which are running at the highest level in history. Net margins are somewhere in the vicinity, a little over 11%. Concern is that wage inflation is picking up. Give you an example. We had the Goldman Sachs Chief Financial Officer Conference in Seattle about maybe 6-8 weeks ago.
Tell them who's there. Tell them the kind of people.
You
Tell
had
them who's there.
You had the CFO of Microsoft and of Amazon, Apple, about 150 other CFOs of major U.S. corporations. And when asked, there was various sessions for the day, not dissimilar from what you have here. And I was having a conversation and moderating a discussion about prioritization of the uses of cash. And there was a discussion as what are the challenges that you're facing. And the number one issue that was recurring in terms of a challenge that the management's identified was labor. And the question they, I think, encapsulates it most clearly is a statement, how do I grow my company without labor? Point being that with 3.7% unemployment rate and falling, wages are rising at over 3%, and that is pressuring margins. But the problem was finding the labor, retaining the employees that they currently had, and then the issue of the skills mismatch to what they were needed and what they were finding in the applicant pool. And so that was a challenge. Now, of course, the response to that is companies have to be spending more, or the logical response is spend more in technology and try to leverage the existing talent, and that's probably the beneficiaries of that. But I'd say that the pushbacks tend to be on the policy related to the Fed and on the expense side. Tariffs becomes a big issue. Exactly what will happen. Well, we can see what happened Monday versus Tuesday on the stock market in terms of whether there was or wasn't an agreement, whether it was a 60-day extension or 90-day extension. So a lot of uncertainty out there. So I'd say tariffs, the policy on the Fed, labor inflation, and margins were sort of the areas we have the biggest source of debates.
So one of the questions is we have penciled in 3 or 4 rate hikes, for, going in December, then 3 or 4 rate hikes in 2019. Your partner, John Hudson, the chief economist, has the same 4 rate hikes. I have the 4 rate hikes. J.P. Morgan has the 4 rate hikes. I think Morgan Stanley has the same kind of number. That's all well and good, except Ms. Market, in our infinite wisdom, says we're all totally wrong. Because basically is we've had a huge rally in the Treasury, we've had a huge flattening of the Treasury curve. So how do you respond to that? Maybe this whole fundamental thesis that we have and your firm has is just complete. The market is saying we're completely wrong.
Well, from a market response in terms of the equity market, so when the chairman of the Fed says that we are very far away from neutral, market goes down. And when the comment is, well, we're awfully close to neutral, the market rallies and thinks that there's more dovish sentiment among the Fed. So I think two observations. The first is we'll get, as you always get, more information in I think it's the 18th and 19th of December when they have the next meeting. But next year, every single Fed meeting will end with a press conference. And that is different from now. In the last several years since Ben Bernanke started the having press conferences, they happen quarterly, or every other meeting. And the new policy is going to be starting in January to have a press conference at every meeting. So I think there's more formal opportunities to be communicating that information. The concern is that the economy has been gaining, on average, 200,000 jobs a month for the last 5 years, from 2013 to 2018, been averaging roughly 200,000 jobs a month, and that's going to decelerate in terms of the labor pool is diminishing, and we expect that to be slowing. And the concern of so many people will be looking at that deceleration. If you see 200,000 jobs a month consistently, and you start to see that slow, concern will be, well, the rate of change is of concern after 5 years of stability.
Okay, Howard Marks the chairman of Oaktree Capital Management, recently wrote a book called Mastering the Market Cycle, and they say how you could put the odds in your favor. And Howard recognizes 5 cycles to look at. He says there's an economic cycle, where you are in the overall, with respect to economic growth. That's what we talked about today. There's a profit cycle. Where are you with respect to whether profits are growing or slowing or declining? There's a stock market cycle, which the stock market goes up and down. There's a credit cycle, which says how do credit spreads, what's the attitude of investors. And there's a risk cycle, whether people are willing to take lots of risk or unwilling to take risk. And risk is sort of the last one where that could be turned on or off. There's an on and off switch with risk. Either you get all the money you want one day, and the next day you can't get anything from anybody. It doesn't matter what the price is. But if you take a look at all these 5 cycles, if you look, especially if you set back where we were in September when the market made its high, you could argue the economic cycle certainly looked like it was peaking, certainly on a rate of change. You could look at the profit cycle as certainly really slowing down, possibly having less growth. Stock market looked like it was extended because the stock market in September, even though it made a high, it was roughly the same where it was in January. In the middle of January, it would have made another high. Credit was very easy, and then I showed a chart which showed credit rolling over where the high yield spread has gone from 3.2 to 4.2% round numbers. And all of a sudden, you have Janet Yellen, you have Chairman Powell talking about there's too much risk in the system right now, especially with corporate credit. So if you look at all these things, how can you be bullish?
So I fully agree, and I would certainly commend the book on Mastering the Market Cycle. It's quite an interesting book, as David described. There's Howard Marks describes a variety of these different cycles. I would certainly not characterize the forecast of Goldman, both economics and on the equity market, as bullish. I would say it is a decelerating economy. It's not necessarily going into a contraction or a recession, but it's certainly decelerating. The equity profit cycle is modest increase, again, because you have some modest level of growth. The one thing about the consumer confidence is the highest it's been in about 15 years. The small business optimism is the highest it's been since 1970s. The data series goes back 40 years. Deregulation, lower taxes. That has certainly animated the proverbial animal spirits. And so the activity is still reasonably robust, and obviously that can turn on a dime, but the expectation is that is likely to continue to grow. So that's your backdrop in terms of where you are in the economic cycle. By next June, if the economy continues to expand, it will be the longest peacetime expansion, or longest expansion period since 1850. Which is
the beginning of history,
which is a long time. So there certainly were long duration-wise, but the argument is it's been a pretty slow recovery, and it's lasted, as I said, almost 10 years. The U.S. stock market is on the verge of a 10-year bull market, so certainly that's been long-lasting, and margins are extremely high. But corporate. The evolution of the constituents in the stock market have evolved. And so you used to have much more of an industrial composition of the market. Now you have much more in technology. More than 20% of the U.S. stock market is technology. You compare that with Europe, where less than 5% of the index is tech companies. And so you have these companies, many of which you would certainly know, household names, growing their revenues at double digits, more than 3 or 4 times the rate of nominal GDP. And then you have companies with margins of 20%. So there's just a lot of cash flow out there, and companies are buying back a significant amount of stock. That's one attribute that's different. While the companies are sitting there at record high levels of profitability, they're channeling a good chunk of that cash back towards buying, repurchasing their shares. And we see that on the trading desk at Goldman, where when the window opens for companies to repurchase shares, they're aggressively coming in and repurchasing stock, certainly on days of weakness. Think about this over the course of a year. Companies are precluded from repurchasing stock about a month before they report their financial results. They're sort of in a quiet period. And so that is when the U.S. stock market is most vulnerable to any macro shocks, even micro developments, because When they're not in that blackout period, there's a natural bid for these shares. And in fact, it's the only bid in the market. So that's the supply and demand for money. When I think about the overall market, I think about the economy, so that cycle. Think about earnings, the profit cycle. Think about valuation. Well, the valuation of the market on any measure is high. You can debate about exactly how high that is, but it's certainly in the anywhere from the 85th to the 95th percentile of historical valuation. So that's high. And then it becomes a money cycle, sort of money flow, which is another way of thinking about Howard Marks in this risk, risk on, risk off. And the point is that high yield bond spreads have gapped out a lot, and spreads themselves have widened in the credit markets. At the same time, we're seeing that strong balance sheets, companies with strong balance sheets have outperformed significantly. And that is part of the more defensive-based strategy of owning companies that are designed to withstand a decelerating economy. So that's how I think about the market in the various parts of the cycle.
Okay. Well, the bulwark of the market until the recent correction has been the so-called FANG stocks plus Microsoft. And FANG stands for Facebook, Amazon, Netflix, and Google. Google, even though it's Alphabet, but Google. And then you throw in Microsoft, which now is fighting out Apple and Amazon for the biggest market cap stock. That's been the bulwark of the stock market for the past 2 years, and most of the gain can be accounted for these stocks until the recent correction. But right now is these companies seem to be under attack by Republicans and Democrats alike in Congress. The president is talking about higher fees for Amazon. Facebook is suffering from a whole horror show having to do with internal management and how they dealt with their issues, and you have also issues of these bots and hacking and what have you. So how can, and these stocks are 20+% of the valuation of the market, plus or minus. Can these behemoths maintain their leadership? And if not them, who?
So the points you make are certainly valid ones, and that is part of the thought process behind a more modest trajectory of the market. And so to take Google as an example, or Alphabet as an example, a company has something in the vicinity of $110 billion in revenue, expected to grow that somewhere between roughly 15 to 20%, call it 15%, which is an extraordinary amount of growth for any company, let alone of that size. So the expectation here is, on our part and part of my analyst colleagues who follow the individual companies, is you'll still get strong growth, and you have a secular shift that continues in terms of advertising dollars moving from print or TV media more towards the internet, and that is a trend that has continued and is likely to continue. That's sort of a secular argument, and that remains a driver. The idea of the market rising at a more modest pace is sort of in line with the broad level of profit increases. And clearly, if we did not have participation by some of these stocks, certainly part of the leadership of the market, as you said, some of the 5 largest stocks, it is difficult if you had 15 to 20% of the stock market by capitalization not move higher. Well, by definition, it's hard to get the rest of it to compensate for that. And you saw that in the most recent rotation when those particular stocks helped drag the overall market lower. Within technology, Apple is the biggest contributor. Within the communication services, Facebook and Google or Alphabet. Within the consumer discretionary, it's Amazon. So these are the big, chunky components of the different parts of the market. You had the financial stocks. Basically, the whole market came down a lot. It was much more of a rotation towards more defensives, away from cycles. Presents better of an opportunity from an entry point.
Okay. One of the reasons why margins are so high, some people have argued, is there's an increase in concentration in American industry. So it's more oligopolistic, or in some cases even more monopolistic, like Google in search, Amazon in e-commerce, and Facebook and social media. But you also have less competition in the airline industry, less competition in a whole host of industries, and all of a sudden, where antitrust wasn't an issue for a while, we have this judge trying to stop the CVS-Aetna merger, even though the Justice Department approved it. And he said it's not going to be a rubber stamp, and the Justice Department is still fighting a rearguard action against AT&T,
Right.
Time Warner. So the question is antitrust, which nobody's really thought about as an issue for a long time, is that something an issue with, especially with the new Congress? And a lot of this isn't partisan, because the Republicans hate Facebook as much as the Democrats hate Facebook right now.
So I think the antitrust issue is a legitimate concern on the part of investors. I think the question is the time span with which that is likely to play out. It took almost a decade when the Department of Justice was litigating against Microsoft.
But Microsoft did nothing while that
to get resolution. I think the biggest issue here is what's the European regulators doing compared with what's the U.S. Regulators. And in Europe, there's different philosophies on antitrust. And in Europe, it's about whether the competitors are being disadvantaged or have more concentration. In the U.S., the antitrust law historically has been revolving around whether or not consumers were being harmed or not. And so there's a strong argument to be made that the consumers have been benefiting from a lot of the innovations that have taken place, particularly in the world of technology. Whereas in Europe, there's much more concern about the competitors being harmed. I think it has to do with the idea of the horizontal mergers versus the vertical mergers. But if you're a company and you're growing organically in the social media space, you have a first mover advantage. And when you're there, it's very difficult to dislodge something. And that's, it's unclear. There's lots of concerns about privacy issues. I'd say that's one area of focus, perhaps concern more so than the antitrust, what the implications are for that from privacy relating to advertising dollars and the revenue stream. I think that's where the risk I would be concerned about, or we focus a lot of attention on.
But let's talk about something more mundane. I mean, you had a horror show getting in from San Francisco to Los Angeles last night on air travel, sitting on the tarmac at SFO. And the question is, we used to have 8 or 9 airlines or 10 airlines, and they were competing, and now we have 4 airlines basically competing. And this is going on in other industries. So it isn't only in tech where you're seeing this thing, and it's not a surprise that airline margins are the highest they've ever been. And the other issue related to antitrust is Warren Buffett owns major stakes in all the major airlines. So he could call up Delta, or he could call up America and just say, hey, don't be so aggressive on price because you have one shareholder owning all the major airlines.
Concentration is definitely an issue, and I expect in the new Congress that, particularly in the House, that there'll be a lot of focus in that area. Okay.
All right. Next issue is, which affects your business, it also affects the public at large a lot, is the whole role of indexation in the market, where basically is the Vanguard 500 is the biggest mutual fund, and if Fidelity has an index fund, there's all these index funds. Then you also have all these ETFs. So there are more ETFs, I think, than there are shares, than there are companies listed on the stock exchange right now. So there are more derivatives. So Ed, we used to talk about derivatives in the fixed income market. There's all these derivatives really in the equity market. They're not leveraged, but you have all these ETFs and index funds. So how does it affect your business when you go talk to clients? Because especially your clients are your clients not Vanguard, your clients are active managers, and active managers are losing market share to the indexers. So how does it affect your business, and how does it affect your view of the market?
So it's a secular challenge that has been going on now for a number of years and is likely to continue. The money flow that we see happening is almost a perfect mirror, in the sense that the dollars that are going into passive, whether it's in the form of index products specifically or in exchange traded funds, that inflow is almost exactly matched with the outflow from active management in the mutual fund industry. And that's been persistent now for the last 10 years. Part of that is the performance of active managers has been challenged in a slowly rising equity market, when the typical mutual fund manager has something in the vicinity of 3% cash, and cash for most of the time has been yielding 0, has been a drag on performance. All else equal, even before you assigned any fees, simply the cash drag has been a retardant to the performance. So that's been a challenge in a rising market. When the market is choppy or is moving more sideways, there's more opportunity, arguably, for some alpha generation, and therefore you could outperform the benchmark. So partly it's money follows performance, and part of the performance challenge has been in a generally rising market, in some cases, quite substantially since the market low of 2009, has made it hard for managers. And the dollars that are flowing into passive products tend to make the dispersion of returns narrower. And if you have a narrower dispersion of returns, it makes it more challenging, once again, to generate alpha. So those trends are unlikely to change. Those are the trends. So it becomes more difficult finding. There's been a shift towards smaller capitalization companies, questions about whether there's bigger opportunities in some of the private companies before they go public. A number of the funds have a side pocket invest in other forms of buying companies before the IPOs. So that's some of the strategies that fund managers are trying to embrace to try to beat a benchmark.
But the thing is, but the big buck hedge fund managers have actually been doing worse than the long-only mutual funds, and they're used to be, in theory, the most highly compensated people in the business, and they've radically underperformed as well. So how does that figure? And you talk to them all the time. I mean,
right. So it's a challenge. It's been a challenge on the macro front in terms of developments. When you're in a zero interest rate environment for such a long time, there hasn't been a lot of macro volatility, broadly speaking, that change. That's arguably been changing more recently, both in the fixed income market and the equity side, the commodity market. Oil collapsing from $80 to $50. Those create more vol, more opportunities. So that's one, if you will, positive development from a opportunity set. The opportunity set is arguably more robust now than it has been in the last couple of years. And the title of our Outlook report for 2019 is The Return of Risk, and the idea of a wider, a fatter tail environment, a fatter tail distribution of outcomes creates arguably more opportunity for both macro as well as micro funds. Some of the points you were just making about antitrust, the question is you're taking a view on litigation risk, whether from a merger arb perspective, whether the government will come in and block certain ones, whether China comes in as taking a view on some of the mergers as well. So there's arguably more uncertainty now, and that creates better opportunities.
or opportunities to lose as well as to make.
Alpha can be positive and negative.
Positive, exactly. The next question is let's talk about cash and portfolio, because you said, cash all of a sudden has a role. And I think Morgan Stanley or somebody else also came out with arguing that cash used to be 0, now it's on the road to 2.5, assuming the Fed goes in a week. It's 2.5. So if somebody's allocation, if an individual's allocation to cash, or let's go with an institution first that you deal with. If an institution's normal allocation to cash was, say, 3%, typical mutual fund, where do you think it ought to be for 2019? If the normal cash allocation in a long-only mutual fund was called 3% historically, where should it be?
So let me answer that question two ways. One, in terms of the mutual funds, some have more latitude than others in terms of their guidelines. One argument is the mutual funds are to be invested, fully invested. That's the ultimate source of the capital. Individuals allocated the money, it's supposed to be invested. And the decision about risk, whether it should be on or off, could be implemented in the form of lower risk stocks, either dividend yielding stocks or some other form. But ultimately the idea is someone has allocated money to a mutual fund to be invested in stocks as opposed or bonds, or whatever product that they've selected. They're expecting it to be in that product, and they create their own portfolio. Let me take it back, and therefore, if the 3% or so is the average, and maybe the range could be from 2 to 5, would be at the higher end. But if you step back for a minute, there are 4 categories of owners of the stock market that really matter. If we look at households, we look at mutual funds, we look at pension funds, and we look at foreign investors. Those 4 categories, you look at the Federal Reserve information, they collectively own 85% of the stock market. 85%. Hedge funds, while they're larger in the public imagination, are about 3% ownership. So they're a little bit lower, more volatility, they trade more, but in aggregate, it's a relatively smaller amount. So let's take those 4 categories I mentioned. Those collectively have 44% of their assets in equities, 44%, and they've got 12% in cash. Now, 44% weighting in equities is a 90th percentile allocation relative to their history. So they are closer to their historical maximum allocation in stocks. And their allocation to cash at 12% weighting is below the first percentile. Wow. So relative to history, they have extraordinarily low positions in cash. And so my recommendation is to basically be buying dips and fading rallies, and that the market is collared in a relatively narrower range, and that's tactically how we would embrace a market that is fully valued. As I said earlier, the valuation is very, very high. So the risk of, or the opportunity set of a PE multiple expansion is pretty low, which means the earnings are what's getting you to a trajectory of the market. And that cash equity balance is a function of what's the opportunity set. So as you said, we're 2 to 2.25% on Fed funds right now, arguably 2.25, 2.5 by the end of this year. And with 4 hikes penciled in for next year, you'll be at roughly 3.5% cash return on cash by the end of next year. And if you had the opportunity to invest for 3.5% return with 0 volatility, as compared with return to equities, maybe a higher return but higher vol, depending on your investment horizon, cash doesn't look that it looks reasonably attractive. And this is for the first time in 10 years that you've really had cash, I would argue, as a realistic and an attractive alternative to owning common stocks.
David, thank you very much, everybody.